Good day, everybody. Hope you're having a good day. Today we're going to move into Chapter 8 in the text. As you can see in the PowerPoint, it talks about audit evidence and giving an assurance in audit reports. At the beginning of the course, we noticed that auditors have to gather sufficient, appropriate audit evidence. And we keep using those words, audit evidence, and you've probably been wondering, what do we mean by that? So today we're going to be talking about what audit evidence is and how auditors gather audit evidence as they conduct the audit of a corporation. But just before we start that, just a couple of comments. Just a reminder that your group project is due this Friday by 6 p.m. latest. Again, you forward that to djones@hewindsor.ca. In addition, each student is required to forward a peer evaluation, and this is a peer evaluation on each team member in your group, where you get to evaluate their performance. Again, you are required to forward a peer evaluation for each of your team members to me at djones@hewindsor.ca. And then I'll be accumulating all that information and grading the reports, and of course letting everyone know what their score is. I've had just one inquiry just about the upcoming midterm exam. I know that week after next we have reading week, and you may spend some time preparing for that exam. So the best way to prepare for the exam is simply to review the PowerPoints that we've covered up to the end of this week, and in addition, review your notes that you've made from my lectures. In addition to that, the group project, of course, has been dealing with a number of topics that we've already discussed, obviously mostly in the ethics area. So you can anticipate there'll be some questions around the ethics area on the midterm exam as well. Okay. After the midterm exam, we'll be getting into the remaining chapters in the text. Most of them deal with the different accounting cycles. So for example, what we call the sales or revenue cycle, being revenue, accounts receivable, cash receipts as one cycle. And we'll talk about how auditors audit that cycle, and then each of the remaining cycles, and we'll get a little more into detail as to actual procedures, okay, that auditors perform, to give you some additional understanding on that. So today we'll move into Chapter 8, as I mentioned, talking about audit evidence. So just reading from the PowerPoint here initially, auditors use evidence to achieve an acceptably low level of audit risk. You recall that auditors do not perform a 100% audit. They have to reduce their risk to an acceptable level. That audit risk is 5% or less, okay, a maximum of 5%, but of course they aim to get the risk less than 5%. How do auditors get the risk less than 5%? The second bullet point here, control tests. So they're talking about internal control tests give indirect evidence that the financial statements are not misstated. The reason it's indirect is because an internal control test tests the process, right, by which accounting information is accumulated. So we're not actually directly verifying whether money is in a bank account or not. We're not directly verifying whether a company has inventory or not. We're using other, what we call indirect evidence, to give us assurance that the financial statements are not misstated. And we've commented before about how important internal control is, especially in a public company setting. Public company top managements tend to have very strong internal controls. We mentioned largely to reduce their own risk, because CEOs and CFOs today have to sign off that the financial statements are accurate and a fair presentation. That's required by our laws, the Sarbanes-Oxley Act in the United States, and similar laws that we have in Canada. In addition, they know that they can reduce their audit fees, right, if they have strong internal control systems. So it is in management's best interest to have a strong internal control system. In addition to doing internal control tests to gather assurance that the financial statements are not misstated, the next bullet point talks about substantive procedures. So here where it says we examine evidence about the dollar amounts and details. So by dollar amounts, they're referring to the actual balance sheet amounts, bank account balances, accounts receivable balances, inventory balances, land, equipment, building balances, accounts payable, income taxes payable, all those dollar amounts, right? We want to gather evidence about whether those dollar amounts are accurate or not. And then, of course, further details, for example, such as the notes to the financial statements. So we gather that additional information, which is direct evidence, right, about whether the balance is correct or not. And we gather that evidence because of the assertions, right? The assertions made by management in the financial statements. So, for example, if management asserts that accounts receivable are properly valued, the auditors want to gather direct evidence about valuation. Right? Is the allowance for doubtful accounts, for example, properly stated or not? The next bullet point mentions 4 key decisions must be made in designing the audit procedures that the auditors do. So the nature of the evidence technique. So the nature, is it going to be an internal control test, or is it going to be a substantive test? The substantive test, before we said there's 2 types. Analytical procedures, which is basically doing ratio analysis on different components in the financial statements, or test of details. Test of details is where auditors are looking at actual accounting documents, right? So invoices from suppliers, bank statements, invoices to customers, right? They're looking at the detail. Those are tests of detail. So we have to decide what's the nature of the evidence that we want to look at. How many items are we going to look at? Right? We mentioned that auditors do not do a 100% test. They select a sample of items. So they have to decide how many, which items to test. So are we going to test items from every month of the year? Are we going to test items from every 3rd month? Right? Are we just going to test items from 2 months of the year? So which items are we going to test? And when the procedures are going to be performed, that's the timing. So I've mentioned before, will we do some of these procedures before the company's year end? So that's most commonly what's done. Auditors will test internal controls. If the client's year end is December 31st, very often the auditors are testing internal controls in the September, October timeframe. Okay, so several months before the end of the year. And then after year end, typically that's when they do their other tests, the substantive procedures, okay, are normally around the year end, which makes sense because when are the financial statement balances available? It's not until year end, right, when management actually prepares their financial statements. So it would be difficult, not impossible, to do substantive procedures before the year end. But in fact, auditors have developed a way to do substantive procedures to some degree before the end of the year. And we'll talk about that a bit later as we go through the course. So how are we going to gather audit evidence? Okay, so as it mentions here, it says auditors set out 6 basic types of evidence and use 6 general techniques to gather it. So typically on a midterm exam, I might ask you, list 3 or 4 types of audit evidence that auditors would gather during the course of an audit. And I might ask you to list 2 or 3, maybe 4 techniques that they use to gather the audit evidence. Okay. So in terms of the types of audit evidence we see here, evidence gathering audit procedures, what's the audit technique and what type of evidence do we gather? So in the left-hand column, the audit technique, inspection. And so inspection means, of course, we're going to look at things in some level of detail, right? So if we're going to look at things, what types of audit evidence might we actually look at? Well, there might be documents prepared by what we call independent parties. So this would be documents prepared by organizations outside of the company that we're auditing, right? So for example, a invoice from a supplier, right? That's a document prepared by an outsider, right? Who would be normally independent of the company that we're auditing. If we send a letter to the lawyer acting for our audit client, right? The letter from the lawyer is coming from the outside. So outside audit evidence tends to be quite important. We may have documents, of course, prepared by the auditee, the company itself, right, being audited. So they may prepare information for their own purposes and give copies of it to the auditor. So these types of documents could be, for example, sales invoices, right, sent to customers. Those are internally prepared documents. Right? Any other types of documents, of course, prepared internally, general ledger, right? All the normal accounting documents, those are prepared by the company. Payroll checks, right? That would be another type of internal document. Purchase orders, right? It's all this information prepared internally, okay? So we have some documents prepared externally. We have some documents prepared internally, but then in addition to that, of course, companies normally have some type of capital assets or tangible assets, things that we can look at, right? So if a company may have, for example, inventory, right? Auditors can count inventory. If clients have purchased a new building, right? Auditors can inspect the building. So there's all kinds of inspection work that auditors can do. Okay, so when we think about inspection, we should think about going into detail in looking at documents prepared by various sources, outside, external sources, internal resources, being the company itself, but then also inspecting physical assets. Okay. In addition to that, the next audit technique is what we call observations. And the type of audit evidence you gather, of course, is just what you see, right? So sometimes in the audit world, we call this auditing by walking around, right? So we can walk around the client's premises and observe how people are performing their daily functions. Are they acting as though there is a segregation of duties, right? We mentioned earlier, separation of duties is a very important internal control. Well, we can observe, right, how people are doing their work and whether there's any problems with respect to separation or segregation of duties. Auditors gather a lot of information with respect to their observations, and of course, they have to document, right, what their observations are. The next type of audit technique, confirmation. Confirmation, as you can see, the type of audit evidence we would gather through confirmation would be statements made by outside parties, right, independent parties. So here's by a confirmation, this is where the auditor is sending a letter, okay, to the independent party. So it could be any type of organization outside of the audit client, asking for information. So here's an example. Auditors will send a confirmation to their audit client's bank, right? And they'll ask the bank, how much money does our client have at your bank? What are the loan balances that our client has with your bank? What type of security are you holding, right, for any loans, right, made by the bank to the client? Okay, and the bank will answer that confirmation and send the letter back to the auditors. So these are statements, right, made normally in writing by outside parties as requested by the auditor. So we'll be talking about the importance of confirmation in the audit process quite a bit after the midterm exam. The next type of audit technique that auditors use, recalculation or reperformance of a calculation is what we're really talking about. And of course, what type of audit evidence would be gathered by doing a recalculation? Well, it would be the auditor's own calculations, right, or performance. So for example, if we look at a sales invoice and it says one item, right, was sold for $100, and the total sale price was $100. We can test the math and say, okay, I can recalculate myself, right? 1 unit times $100 equals $100 sales price. So I know the computer system, right, is correctly doing the math, right? Because I have recalculated what the sales invoice should be. In Canada, we add HST, right, harmonized sales tax, to our invoice amounts. So if the invoice was $100, we can look at the invoice and see the computer added $13 for HST. Is that correct? Take the sales invoice amount, $100, multiply by 13%. The tax is $13. Yes, the computer correctly calculated the amount. Okay, so auditors during the course of the audit will do various recalculations. Another example of that would be if the client records depreciation expense, right, during the year. So we know when you record depreciation expense, you have to know the cost of the asset. You have to know what the residual value of the asset is. You need to know the useful life of the asset. And with that information, you will calculate the annual depreciation. Well, the auditors can take that information and then recalculate themselves what the depreciation would be for the year, right? So, of course, auditors need to document that information when they do it, but that's a form of recalculation as well. So by recalculating the client's depreciation amount, the auditor has substantive evidence that the depreciation amount is correct. So auditors do a lot of recalculation during the course of their work. The next audit technique, analysis. So analysis really ties into the analytical procedures, right, that we've mentioned several times already. And analytical procedures are very important because it is a very efficient way to perform an audit. It's not the only procedure you need to do. Of course, auditors, where they can, want to test internal control systems because that's very efficient. Auditors are also required, right, to do substantive tests, either analytical procedures or tests of detail as determined in the circumstances. But when we analyze data, of course, the audit evidence we obtain is information with respect to the relationships amongst the data set that we're looking at. So for example, if we calculated a gross profit percentage, we would calculate gross profit percentage perhaps for the prior 2 years and compare that to the gross profit percentage this year, right? So in the last 2 years, let's say the gross profit percentage was 52%. We calculate this year and it's 52%. Well, then that is data relationship, right? Telling us it's consistent with the prior 2 years. Based on our knowledge of the business, we know that the client's business has not changed much during the year, so we would expect the gross profit percentage to be the same. On the other hand, if we look at the last 2 years and we see that the gross profit percentage is 52%, and then this year, right, it's 42%, well then that looks unusual, doesn't it? It looks as if there might be something wrong. As far as we know, the client's businesses have not changed during the year, same customers. So we would have to investigate further, why did the gross profit percentage drop to 42%? Maybe we had some old inventory that we had to write off, right? So the cost of goods sold was a higher amount this year, resulting in a lower gross profit. But by looking at data relationships, right, that type of audit evidence, it gives you a hint, right, or it directs you into the further audit work that you need to do, right? Usually analytical procedures by themselves do not give you an answer to a question, okay? But they do point you in the direction that you need to move in order to obtain an answer to a question. The next type of procedure, inquiry, right? Inquiry just means we're going to ask people, right? So we see when we inquire, we're going to receive statements, right, made by different people that work in the audit client. So we may ask the controller questions, we may ask the CFO questions, we may ask the manufacturing manager questions, we may ask, right, the marketing vice president questions, we may ask the human resource vice president questions, right? So all these questions, the auditors are going to gather and put down what the answers are to the questions. This is very important because during the course of the audit, the auditors are looking for consistency, right? They're looking for consistency amongst the information that's being gathered. And so I often said when I was doing auditing full-time myself, you know, what's the story, right? What's the story that I could put together about this audit client this year and what's gone on? Are all the pieces consistent, right? It's like putting a puzzle together, right? And if we call the puzzle the audit, can I put all the pieces together, right? Do I get a picture at the end when I have the puzzle completed? And that's really what the audit is. Can I put all the pieces together and have it present a coherent picture, right, where I'm satisfied that the financial statements present fairly based on all the information that I've gathered. Of course, where statements made by different parties are inconsistent with each other, right? That's an indication the auditor needs to go further, right, and gather perhaps different types of information, gather different types of audit evidence, do different types of procedures, do other procedures which maybe are more in depth, right, in order to gather the proper information that they need in the circumstances. Okay, so the next few PowerPoints, again, they just give you some additional background, okay, with respect to each of the items that I've just mentioned. So I'll just scroll through these. Again, you can take your time and read through these if you would like for additional detail beyond what I've said. So for example, here they're talking about inspection. So inspection, I've mentioned, you know, counting inventory, reading a lease agreement, right? You're looking at things in detail. Just going to the next one here. Something we call vouching as part of an inspection. Vouching, I'll just cover this off here while we're in this PowerPoint. It says information is selected from an account. They're talking about an account in the general ledger. And the auditor goes back through the control system to find the source document. Okay, so they're saying that if you look at the repair and maintenance expense account, let's say for a client, and it says $2,000, and that was paid to Joe's Truck Service. Well, if we go back to the invoice from Joe's Truck Service, is there an invoice there for $2,000? And what was that spent for? Okay, so vouching an expense means that we go from the recorded data back to the original document. Okay, you want to remember that term of vouching. Vouching is when you're looking at what's been recorded and asking yourself as the auditor, is that number correct? You determine that by tracing back, right, to the actual invoice to support that particular expenditure. Then we have the word tracing. It says the auditor selects source documents and proceeds through the control system to the final recording of the transaction. Tracing supports completeness. So vouching, okay, when we vouch an expense, we trace from the general ledger recorded amount back to, right, the supplier invoice. Tracing, we're tracing from the supplier invoice into the general ledger because we're trying to determine, are all the expenses recorded, right? So if we want to determine if all the expenses are recorded, what would we do? One thing we could do is, of course, go to the file, a particular supplier file, and trace those invoices into the general ledger to make sure that they've all been recorded. That gives us audit evidence around completeness. Okay, so again, those, you might want to keep those two words in your minds. Okay, vouching is going from the general ledger back to the source document. Tracing is going from the source document into the general ledger. You see, tracing is the exact opposite of vouching. Okay, that's the point I want to make here. And we'll see this again later as we proceed through the course. So scanning, very often, again, the auditors will talk about, oh, I scanned this or I scanned that. By scanning, it just means we're keeping our eyes open. Okay, we're looking for things, right? So as I walk around, right, I mentioned auditing by walking around, I'm scanning, right? I'm looking and seeing what people are doing, right? I'm not looking at things necessarily in detail. It's just giving me some indirect evidence about what's going on. Okay, so it's really comes back to my auditing by looking around approach. Observation, again, we've already talked about. Confirmation. I'll go a little more into confirmation here as they do. I've mentioned the bank confirmation as one example. And as we see here, it says external confirmation consists of written inquiry to verify accounting records. So as I was talking about the bank confirmation. So if the client says we have $1 million in the company's bank account, do they? Well, as the auditor, you would send a confirmation letter to the bank asking them, right, how much money does our client have at your bank? And there's actual form. We'll see it later in the course when we get into that cycle. There is a bank confirmation form we'll look at. And the auditors, right, management has to approve the confirmation being sent to their bank. But when the auditors send the confirmation, okay, they don't put any numbers on the actual form because they're asking the bank, you put the number in, right? You tell us how much money our client has with you. You tell us what the loans are, right? You tell us what the security is, okay? And of course, they're asked to give that information as at a particular point in time. Okay, so bank confirmations, standard approach in any audit. They talk about accounts receivable confirmation here as well in the second last bullet point. Again, auditors gather a lot of audit evidence with respect to doing external confirmations. External confirmations because it's high quality audit evidence that you're gathering from organizations outside of the audit client, right? That's the key. It's from outside. It's not produced by the client. It's not internally generated, right? Because if information is internally generated, we always sort of have that issue. Well, has management changed the document in any way to make it more to their favor? Right? So auditors try to get as much external information as possible. So I've mentioned the bank confirmation. Another one they mentioned here again is the accounts receivable confirmation, right? So if management is asserting in the financial statements that we have accounts receivable of $3 million, and that consists of a large number of accounts, and there's various amounts owing, the auditor will send a confirmation, simply a letter, to that customer, right, asking them, do you owe our client, $100,000? If you do, sign here, right, on the confirmation letter that you do. If you disagree with the amount, please explain why. Okay, and then they want the customer to explain maybe they don't owe $100,000. Maybe they only owe $80,000 because they sent a check for $20,000 last week that your client hadn't received yet. So there can be differences, but the auditors, of course, have to investigate those differences. Okay? But the external confirmation itself, if the client writes back and says, yes, we owe $100,000, well, that's, of course, very positive, right? Because then the outside customer is giving the auditor external evidence that what management is asserting is correct. That account receivable does exist, okay? And then in addition of talking about accounts receivable, that's an asset, but we can also send out confirmations for debt, right? Amounts owing. So if, let's say, our audit client borrowed $10 million from an insurance company, we can send a confirmation letter to the insurance company asking them to confirm the amount of the debt, right? So again, we would normally put in the amount of the debt. We would put in what the repayment terms are, right? Monthly payments of X dollars. We would put in what the interest rate is. We would note any security. And then we ask them, to confirm whether that information is correct. If it's correct, fine, sign here, send it back to us. If it's not correct, please write back and let us know why. Again, this is information coming directly right from the lender, right? So because it's external, again, it's high quality audit evidence. Now, just some general information with respect to confirmations, and again, I'm going to mention it here because when we get into the detailed cycles, we'll be talking more about it as we go through the course, okay? But so this gives us background on confirmation procedures, whether we're confirming assets or whether we are confirming debts, okay? Confirmations should always be on the client's letterhead. Okay, so it's on the client's letterhead. When I mentioned earlier, the auditor sends it. Oh, what I'm referring to is the auditor actually controls the mailing, okay, of the confirmation. But the confirmation letter itself, right, is actually a request by management to their customer or to their lender to confirm the information to their auditor. Okay. And of course, it has to be signed by the client officer because of privacy laws, right? Information can't be released to third parties unless, right, the company authorizes it. So that's why it's always signed by a client officer. The auditor, it says, needs to ensure the address on the confirmation is legitimate, right? So we don't want the CFO sending the confirmations to his own house, right? And he'll just sign them when they come in saying, yeah, everything's fine. So the auditor wants to verify the addresses, right, as to where the confirmations are going. The recipient should be able to provide the information, right? So we shouldn't be asking the person we're sending the letter to for information that they can't provide, right? That would prove frustrating to them if we did, and then they might not return the confirmation, right? So that would take away from the process, right? We want to get the confirmation letters back, right, for audit evidence. As I mentioned a few minutes ago, the auditor has to control the actual mailing process. The reason for that is we don't want to let management make these confirmation letters and then we, as the auditors, say, yeah, go mail them out. Well, then management might change them, right, after we've looked at them before they get mailed out. So we can't have those confirmation letters changed after we, as the auditor, have reviewed them. So we control the mailing, okay? And the responses, of course, as I mentioned, the responses always come from the party that we're sending the letter to. It always comes back directly to the auditor. It does not go to management and then the auditor, right? It goes from the confirming party directly back to the auditor. So the auditor controls the mailing out of the letter. The auditor receives the confirmation letter back directly from the external organization. It does not go through the hands of management. Why? Because we as auditors don't want management to manipulate anything, right? So you can see what's happening here. Auditors are trying to control, right, the entire process, okay? With respect to confirmations, essentially there's two forms of confirmations. I want to make you aware of them because as members of management, you could possibly see both types. The most common form of confirmation is the positive confirmation. Okay, in a positive confirmation, as you note here in the PowerPoint, it says a reply is requested in all cases, right? So in a positive confirmation, I'll give you an example. Let's say we're going to confirm the balance receivable from a particular customer, okay? So that customer owes our client $1 million. So the letter, confirmation letter is made up, right? Management prepares the letter. It's addressed to their customer. It says, please confirm directly to our auditors that you owe $1 million, okay? If you agree, sign the letter, send it to our auditors. If you disagree, explain why you disagree with $1 million and send the letter to our auditor. right? It always come back to the auditor. They always request a reply when the confirmation is positive, okay? Um, Now, if letters don't come back, then the auditors have to follow up, right? Usually by follow-up, they send a second request. They send the same letter a second time, okay? In addition, if the letter still didn't come back, then they're going to try and follow up by way of contacting the customer, right? To see if there's some reason they didn't return the confirmation letter. Maybe the mailing address was incorrect for some reason. Okay, postal code was wrong, right? Minor things can happen. Okay. Uh, so they'll try and contact the client in some way. If they can't contact the customer, then they're going to do additional procedures to determine whether that amount is receivable or not. So those additional procedures would include usually going back to the actual invoices, right, and going back to shipping documents to see were goods actually shipped to that customer or not, right? Or was the time spent right on that client's file that they were invoiced for. Okay, so it would be a matter then of going back more into the detailed records to substantiate the amount showing as receivable. The other type of confirmation, which does exist but rarely used, is a negative confirmation. And as you can see in the PowerPoint, it says a reply is requested only where the information is incorrect. So let's come back to that confirmation again of the account receivable. So the confirmation goes out to the customer and it says, if you disagree with the balance, please note why and send this letter back to our client, or sorry, to our auditor. Okay. If you agree with the balance, nothing, you need not do anything. You don't have to send the letter back. So what could happen in a case like that? Many confirmation letters could be sent out to the customer, but all the customers of the business, but then the auditor might not receive any evidence back, right? And so that's called negative confirmation. They didn't send the confirmations back because they agreed with the balances. Now you can see there's a lot of assumptions, right, made in that process. How do we know all the mailing addresses were correct, right, for all the customers? Do we know that? We think we know that, but do we actually know it? And I've always mentioned to students when I'm teaching auditing is you always have to be concerned as the auditor about, am I going to have to go to court one day, right? And you're going to have to defend, was your audit done in accordance with generally accepted auditing standards? And you're explaining to the judge while you're giving evidence in court, right, that you gather sufficient appropriate audit evidence to support accounts receivable. And then the judge asks you, well, did you receive any confirmations with respect to the accounts receivable balance? And you say no. And then the judge is going to say, well, can you explain to me how that's sufficient appropriate audit evidence? Well, and then you're going to have to say, well, judge, my evidence is that's appropriate because I received no letters back, right? I got no letters back, so that's my evidence. There are no letters. Well, the problem with that approach is we know there are no letters, right? And so does that mean that the balances are correct or not? So to me, I'm not sure a judge is going to be able to understand, right, why you as an auditor feel that no evidence actually gives you evidence, right? So 99% of the time, auditors, of course, use positive confirmations, okay, because of that potential problem, right, with respect to the use of negative confirmations. Now, I'll give you an example because some of you may run into this. If you work for a financial institution, what you might see auditors using negative confirmations in a financial institution. The reason for that is this. Financial institutions are in the business of making loans, right? And as they make loans, some of those loans are outstanding for many years. So what auditors often do is in the year that a loan is first granted, they will use a positive confirmation to confirm that loan balance, okay? So in the year that the loan arises, they use positive confirmations. But then if that loan is there for the next 25 years, because that happens to be a mortgage loan, in the following years, they will use negative confirmation, right? Because they've already confirmed it in the first year, right? The person that owes the money confirmed it as being correct, and then we'll just use negative confirmations. Because in year one, we know the loan exists. And then after that, it's just a matter of whether the payments keep coming in or not. So very often, in the first year, auditors in a banking context will use positive confirmations for new loans, and then in subsequent years, for those same loans, they'll use negative confirmations. And again, in subsequent years, only use positive confirmations for new loans, right? Because the risk really is on new loans, not on loans that were pre-existing in other years, because they've already been audited, basically. Okay, so in some limited circumstances, negative confirmations are useful, but again, as I mentioned, 99% of the time, confirmations are normally positive confirmations, not negative. Excuse me. So recalculation, reperformance, again, we've already talked about. I gave the example of recalculating taxes, for example, on an invoice. Right? Recalculation of depreciation expense would be quite common. Analysis, again, analysis in terms of ratio analysis is comparing gross profit one year to another, comparing accounts receivable turnover one year to another, as I mentioned in the PowerPoint, comparing inventory turnover, right, one year to another. All this data, right, all these calculations give us sample data on which we can draw conclusions and direct us to other areas if we believe we need additional audit evidence. Okay. When we talk about analytical procedures, again, it's a broad word, so let's just talk for a few minutes. What types of things are we talking about? Okay, so I've mentioned financial ratios. So financial ratios to ourselves, right? Financial ratios compared to the last year. And normally I always say, compare the current year ratios to the last 2 years, right? Because you usually need more than 2 years to determine a trend, okay? If you have a competitor, it's useful to compare financial ratios to competitors, right? So if we wanted to look at what's the gross profit in General Motors, right, compared to what's the gross profit in Toyota, right, and see if those gross profit percentages are in the same range or not. And if they're not, try to analyze why they might not be. Right? So we can compare ratios, financial ratios to ourselves, our previous year results. We can compare it to other competitors. Or if we had industry information, as the PowerPoint mentions, if we had industry information, which we felt comfortable with, right? It's from a reputable source, sure, we could compare our ratios to the industry norms and figure out, why are our ratios better or worse? In addition to other types of comparison we can do, as I mentioned, compare current year to prior year. As I mentioned, usually the last 2 years is better than just 1 year. Large companies do budgets, right? And what's a budget? A budget is essentially a financial plan, right? Here's the sales we plan to achieve, here's the gross profit, here's the bottom line we want to achieve. And then as we proceed through the year, we compare to that budget. And we're going to determine, did we meet the budget? Did we not meet the budget? And why? Okay, well, the same thing happens for auditors. When they get there at the end of the year, they can say, well, did we meet our budget or not? And why didn't you as management meet your budget? To get explanations as to what's gone on during the year. And then the auditors, again, can take that information and determine whether they have any concerns about that information or not. We can compare current year balances as said against other current year balances. So what they're talking about there is if our bank balance this year is $100 million and our bank balance last year was $150 million, we might ask ourselves, where did $50 million go, right? We have to make sure we can explain that. So one of the things I would always do, and before I became a partner in the audit firm with Deloitte, one thing I would always do is create a memo at the end of the file when you're done the audit file, explaining to the partners, right, the changes in the financial statement components. Cash went up for this reason. Accounts receivable went down for this reason. Inventory went up for that reason, right? And you can explain what's going on in the business and demonstrate your knowledge of the business, right? To, of course, to your boss, the audit partner, in my case, or other team members. Okay, so doing a memo right at the end of the audit is very fruitful and is required by all audits. Okay, all the audit firms have that as a standard procedure. Memo to the partner at the end of the assignment to demonstrate why you feel the financial statements present fairly. But we're just comparing the current year balances, whether that's on the balance sheet or whether that's in the income statement, or if that's in the statement of cash flow. We're just comparing to the prior year to say, can we explain what is happening, right? Can we explain all the trends? And remember, a few minutes ago, I mentioned the puzzle, right? When we put all the puzzle pieces together, do they all make sense or not, right? If the picture looks okay, the financial statements probably present fairly. If we're missing a piece, right, or something's wrong with the picture somehow, right? We put a piece in upside down, there's something wrong, okay, then we perhaps have to go further, right, to figure out what's happening. Then in addition, sometimes it's sometimes useful, not that often, but yes, the last point here says study the relationship of balances and non-financial information. So for example, payroll expense is up 10% this year. So the non-financial information they're talking about, well, if payroll is up 10%, why would payroll be up 10%? Well, it might be because wages went up 10% this year, but the number of people did not change, right? But if payroll went up 10%, you can say, well, we hired 10% more people this year, so payroll should be up 10%, right? So we look at non-financial data, such as number of employees, to infer what should have happened to payroll expense during the year. So if payroll expense is up 10% and the number of people we hired is up 6%, hopefully there was a pay increase of 4%, right? Because we should be able to take the number of people hired, right, and add it to the percentage of pay increase to get the total payroll change during the year. And so we break down, right, the changes and analyze them a little more in depth. Sometimes we can look at non-financial data to rationalize and justify the numbers that appear in the actual financial statements. We've already mentioned inquiry, and the important thing about inquiry, I mentioned, we want to determine whether the information is the same or not, right, that we obtain from different people. So that's called corroboration, right? So when we talk to 6 different people, right, at our audit client's premises and we get the same story, then we know they are corroborating each other, right? And if you have the same information from 6 people, guess what? Your information is probably correct, right? And of course, talking to people helps us understand what's going on in the client's business. So that helps us as auditors gain knowledge of our client's business and understand the audit evidence as we gather it, right? So inquiry, very important. Okay. We have another type of situation in the audit world. I've mentioned 2 types of tests already, an internal control test and a substantive test. But we also have some tests, some audit procedures, which serve both purposes, okay? They're both a control test and a substantive test. So this dual purpose audit procedure in the PowerPoint says are multi-step procedures that are designed to meet the purpose of a control test and the purpose of a substantive test. Okay, so let's just read what the PowerPoint says on this. It says by using several different evidence techniques on the same sample of transactions, dual purpose audit procedures combine steps to test the effectiveness of an internal control procedure with steps that give substantive evidence about the resulting monetary balance, rather than doing the test separately, thus increasing efficiency. Just going to go one further. Okay, it doesn't talk about it, but I'll mention what it is here. So the type of thing that they're talking about here in this PowerPoint would be this. Let's think about a client's bank reconciliation. Okay, so everybody's aware a bank reconciliation is where typically the controller or the accounting manager for the audit client will reconcile the balance of the bank account between the general ledger and the balance of the bank account per the bank's records, right? So if the general ledger says we have $10 million in the bank, and the bank statement says you have $8 million in the bank, there has to be a reconciliation done, right, of those two numbers. And so, and this will help with respect to internal control as well. So this client standard procedure is that one individual actually does the reconciliation and determines what all the components are, okay, that make up the difference between the 10 million and the 8 million. And then someone else reviews that and approves it, okay? So the person approving, okay, so let's say the accounting manager prepares the bank reconciliation and passes it up to the controller. The controller reviews it and initials it as being correct. So the internal control test that the auditor would do is they would select the bank reconciliation for a number of months during the year, let's say 4 months, and they would look at those 4 months to ensure that the controller's initial is on the bank reconciliation. Assuming the controller's initial is on the bank reconciliation, that's an internal control test, right? Management is saying we rely on the bank reconciliation and its approval, right, to substantiate why our bank balance is correct. So the auditors look at the approval. Is the initial there? Yes. So it gives us indirect evidence about the bank reconciliation being correct. But at the same time that I have that bank reconciliation in my hand, I look at some of the underlying documents that make up the difference between the $10 million in the general ledger and the $8 million in the bank, according to the bank statement. Right? I physically look at what some of the differing components and justify, while I'm looking at the one document, right, the substantive balance of cash, okay, in the bank. And so I'm looking at one document and achieving the test of an internal control by looking for the initial, and by looking at the underlying documents that support the bank balance at the same time with the same document. Right? So there's actually a dual purpose audit procedure by looking at that bank reconciliation. I'm gathering indirect evidence that it's correct because the controller's initial is there, but I'm also gathering direct evidence that it's correct because I'm looking at the underlying reconciling items to ensure that they are also valid. Okay, so I'm getting audit evidence from two different aspects: internal control tests and substantive tests, all tied into one, looking at one document to achieve it. So the more auditors can look at one document and achieve both internal control tests and substantive tests by looking at one document, that makes the audit very efficient, right? The more you can do that, and of course, auditors try to ensure that they will do as many dual purpose audit procedures as possible. They're not all that way, but to the extent you can do it, of course, it creates a very efficient audit. Okay, the next PowerPoint talks about business information sources and methods. It says for continuing audits, so by continuing audit, they mean audits that are recurring from year after year after year. Information about the client is available in a permanent file. A permanent file is simply a file maintained by auditors for information which does not change from year to year. Okay, and so That could be, for example, um, articles of incorporation when a company is first incorporated. That goes into the permanent file. It could be information about management organizational structure. Okay, who reports to who? That goes into the permanent file. Okay, all types of information. It could be about their IT information system. Okay, normally that doesn't change much. That could go into the permanent file. So things that are of a permanent record, not expected to change year to year, that's going to go into the permanent file. The information that is gathered about this year's audit goes into the current year audit file. Okay, so we have a permanent file for information that doesn't change year to year. And then we have a current audit file for the information that's being gathered during the current year audit. Okay, other sources of information in the conduct of our audit. The first bullet point, observations and tour of the company's physical facilities may indicate conditions that should be reflected in the financial statements. So normally one of the things that the audit team does right at the start of the audit is have a tour of the company's premises. Okay, so jokingly we say, well, when we get to the client's premises, we have to find out where's the lunchroom, right? Where's the washroom, right? So we need to know where those things are. But beyond that, of course, we're doing what? Even on the first day, when we're introduced to the client's facilities, we're auditing by looking around, right? We're observing, right? So maybe on our plant tour, right, we see a bunch of inventory sitting in the corner that's got 2 inches of dust on it. Well, that may be inventory. We might ask, has the company written that inventory off? Doesn't look like it's moving, right? 2 inches of dust on it. So a tour can actually reveal conditions that need to be reflected in the financial statements. Maybe that inventory hasn't been written down or hasn't been written off. Right? Or we may see a bunch of machines, right, that are sitting idle. Looks like they haven't been operating for a while. Well, what's the intention around those machines? Are they going to use them? Are they going to sell them? Maybe they have to be written down the net realizable value, right? So by doing a plant tour, yes, it familiarizes you with the client's premises, but it's also a really good way to gather information. And although you do a plant tour when you first go to the client's premises, that doesn't mean you stop there. You can do a tour around the plant during the audit. Right? So you may be at the client's premises for 2 weeks. You may walk through the plant a couple times, right? However many times you want to walk through there, you can, because you're the auditor and you're entitled to gather whatever audit evidence you need and talk to whoever it is that you need to talk to. Okay, so again, auditing by walking around could be a very fruitful source of information. Again, there may be other industry information, usually not, okay, in today's world, usually not, because many businesses are so highly specialized, right? There may be 1 or 2 competitors, but to say that there's an entire industry, it'd only be a very small number, right, of industries which would be homogeneous enough to be able to compare your client's data to. Typically, if you can get information about public companies, that's usually the best thing to do. So for example, if you're auditing General Motors, you might want to go and get Toyota's financial statement and compare it, right? Comparing General Motors to even some other smaller manufacturer might not be that comparable, right? And there may be so many differences in the financial statement numbers. It may be hard for you to rationalize and come up with reasons as to why the numbers are different. So yes, for very, very large businesses, yes, public company databases and guides and magazines may be helpful, but generally not, okay, generally not as a rule. And of course, there's time, right, that would have to be spent to gather that information if you did want to use it, okay? All right, so I'm just going to stop there for a few minutes. I've been going on for about an hour or so now. So I'll stop for about 5 minutes, okay? And I'll be right back and we'll continue on. Thanks, everybody. See you in a few minutes. Okay, hi everybody. We'll continue on. As we see in this PowerPoint, we have other evidence auditors can obtain. Internal audit is an interesting scenario. We'll talk more about this later in the course as well. But very large companies have internal audit departments, and of course, internal auditors are gathering a lot of audit evidence throughout the conduct of their work. So basically, back in the 1980s, uh, management of large companies were challenging their external auditors to use the work of some of their internal auditors. And over a period of time, the external auditors found a way that they could rely on the work of internal auditors. Again, we'll talk about this more later in the course. But the external auditors on day one could not really accept the work of internal audit because there was a question around the competency of the internal auditors. Very often, a lot of them didn't have training in auditing or even accounting. They were from other parts of the business. They didn't really understand auditing or know much about it, let alone accounting. So the quality of their work was at issue, the competence was at issue, had inadequate training to do the work, right? So lots of issues. Over time, these issues have been resolved, but again, it was over many years. But in today's world, yes, internal audit departments do consist of very qualified people, and as a consequence of that, the external auditors do put assurance and reliance on the work of internal auditors. Again, we'll talk about that more later. Experts, other outside experts, so it could be forensic analysis that has to be done. It could be valuation type work that has to be done. There could be environmental damage type work that has to be done. In an insurance company, the auditors may have to hire actuaries to help them with respect to auditing the liabilities under various insurance policies that are in place. So yes, the auditors from time to time may have to obtain the work of experts and put reliance on that. Again, there are separate auditing standards that govern how the auditors can put reliance on the work of experts. Okay, so we come back now to talking about some general concepts that a few of which we've mentioned before. We have to obtain sufficient, meaning enough, appropriate, meaning the right types of audit evidence. Right? As the PowerPoint states here, accounting records are evidence, but not sufficient evidence for an audit opinion. Why would that be? Well, they could be recreated by management, right, and not really exist. So auditors have to obtain corroborating evidence, and evidence such as we've already talked about, right? Analytical procedures, confirmation work in particular, getting information from outside of the organization to give credibility to what management has recorded in the financial statements. Okay, when we talk about sufficiency, we pretty well know what that is. It means, do we have enough? But how about appropriateness? So this PowerPoint addresses the issue, when is audit evidence appropriate? Audit evidence, to be appropriate, it must be relevant and it must be reliable. What does it mean to be relevant? The audit evidence must relate to one of management's assertions. Think about the assertions. What are management's assertions? Existence, right? Existence of assets, valuation of assets, right? So if you want audit evidence about existence and valuation, you have to obtain evidence which is relevant, right, or meaningful to those evaluation, to those assertions. And then is information reliable? The reliability audit evidence depends upon what is the nature of the evidence and its source, or where did it come from. Reliability combined with relevance determines how persuasive the audit evidence is, right? So this is always something I always thought of when I was doing auditing myself full time, is I'm gathering all this audit evidence. Is it relevant and is it reliable? And then using that information to determine how persuasive is it, right? In terms of supporting management's assertions in the financial statements. So we have a hierarchy of evidence, right, to judge reliability. Again, remember, reliability depends on nature and source, right? So what's our hierarchy that we're talking about? What's the most reliable type of audit information that auditors can gather? Well, things I physically inspect, right? Things I can touch myself. Right? If I can touch the inventory, it probably exists, right? Because I can physically touch it. Confirmation, and by confirmation, we're talking about external confirmation, because then I have persons from outside the organization telling me certain statements are true, right? So that's pretty good evidence. External documentation, so information from the outside, such as invoices from suppliers, right, outside of the organization. That would be good documentation. And then recalculation or reperformance of calculations that I perform myself as the auditor. So I already mentioned today retesting tax calculations, retesting depreciation calculations, right? That's reliable because I'm doing it, right? What's less reliable information? Well, information which has only been generated internally. Okay, it doesn't mean that it's not reliable at all. It's just less reliable, and that's why it says in brackets here, good internal controls. Okay, assuming that fraud has not occurred and that the internal documentation, okay, is not fraudulent, then it is reliable, but not as reliable as external information. Right? It's less reliable. Internal documentation would be information which started from the outside, but then was finalized inside in the company itself. Okay, so it's a combination. It's created internally and externally. Things that we observe, we can see, but what we have to remember there, it's at a point in time, right? What I see today might be different than what I see tomorrow or next week, right? So the fact that I see something happen one day, right, does that mean it's going to happen every day or in the future? Or did it happen every day in the past? Maybe not, right? So it is something we observe and we see, and we have to react to it, but yet it's perhaps less reliable than some of the other items already mentioned here today. Excuse me for a minute. Managed to catch a cold here. And then the next item, analytical procedures, it says with specific data. So analytical procedures in themselves, okay, we cannot just do those procedures by themselves. I mentioned earlier today, analytical procedures point us in a direction, right? It is a substantive procedure, but auditors must always do some tests of detail in addition to analytical procedures. It's not one or the other. They're always required to do some level of detailed testing. Why? Because the analytical procedures we're relying on are assuming, right, to some degree that the underlying data is correct. How do we know? We need to go a little bit further, right, and actually look at some of the source documentation. So analytical procedures, it's helpful, but again, not as reliable as external information, right? Analytical procedure, we're still dealing with information created by management, right? So it could be susceptible. This means we have to be careful, right, as auditors. Least reliable, right? So we're coming down. So I'll just go back to the other PowerPoint. So the most reliable are basically things from the outside, right? Less reliable are things from inside, okay? The least reliable, things which are from inside if you have poor controls, meaning that it could be a high degree that it's actually fraudulent, right? Inquiry, okay, least reliable if we talk to one person, right? If we inquire and we get the same information from a number of people, it's somewhat more reliable. But if we only talk to one person by itself, it's not that reliable, right? Because it hasn't been corroborated or tested, right, by discussions with other people. And then broad analytical procedures, again, they're talking about very high level procedures without going into depth. So, for example, if we look at a gross profit percentage on an income statement for the year for all products, well, that gives us some information, right? If last year's gross profit was 52%, this year's is 52%, it looks reasonable at a high level. But does that give us a lot of good quality audit evidence, but the quantities recorded in the financial statements are correct, and that the sales prices are all recorded correctly, right? Not really, right? Because those analytical procedures are at too high of a level by themselves. So we have to go deeper, right? Going deeper means we have to test the internal controls that generated the data and or do some tests of detail, right, to substantiate the numbers that we're looking at. Okay, so generally we could simply say that the most reliable audit evidence is information generated from outside the organization. The least reliable is information that comes from internally, right? And whether that's accounting information that's been generated internally, or whether that's even observation and analytical procedures we do ourselves based on management's data, the fact that it's only at a point in time and the fact that the data is susceptible to change by management, it's less reliable, right? So that's why auditors go to the outside, right, for evidence as much as possible. As we already mentioned today, sufficiency has to do with how much, right? How much is enough, right? So I've mentioned before, every time I came to sign an audit report, those questions went through my mind. Do I have enough audit evidence that these numbers are correct, right? And do I have the proper type of audit evidence that I should have? Now, with respect to how much appropriate evidence is enough, it states there's no official standard. The auditors must use their professional judgment. That's right. We say we have sufficient appropriate audit evidence, do we? Okay, so it's in the professional judgment of the auditor, depending on the extent of the work that they've done. As the PowerPoint states, the test of sufficiency is whether you can persuade someone else that you have collected enough evidence to support your conclusion, right? So what that is saying is you have sufficient evidence when that evidence would convince someone else that your conclusion is correct. If you have enough evidence to convince someone else that your conclusion is correct, then you probably have enough evidence, right? It's not a matter of whether there's enough to convince yourself. It's a matter of, do you have enough to convince someone else, like a judge, right? If you had to go to court. And from an auditor's perspective, that's what you're always fearful of course, is a lawsuit. So you want to make sure you have sufficient appropriate audit evidence. Now, the next PowerPoint mentions, in order to reduce detection risk. Okay, remember we said audit risk is a function of three types of risks. Inherent risk, which is driven by the nature of the item. Control risk, which means we'll manage the risk that management's internal control system will not prevent, detect, and correct a material error in the financial statements. And then detection risk is the risk that the auditor's own procedures will fail to detect and correct material errors in the financial statements. So it's that risk that we're talking about in this PowerPoint. So in order to reduce detection risk, and because detection risk is a component of audit risk, right? So if we do reduce detection risk, we do reduce audit risk. More evidence is required to support an opinion, right? We need more evidence. So to reduce audit risk, only detection risk can be affected by the auditor. Is inherent risk determined by the auditor? No, that's dependent on the client's nature of the business, right? If the client is a bank has a susceptible asset called cash. Can the auditor affect that? No. If the client is in the jewelry business, jewelry can be stolen, right? It's small. It's easy to put in a pocket and walk away with. Can the auditor change the nature of the jewelry business? No, right? So the auditor cannot affect the inherent risk of the client's business. How about control risk? Can the auditor influence control risk? No. Why? Because management decides what the internal controls are, right? Not the auditor. Management does. So it's because management controls internal control, the auditor does not. So the only thing that the auditor can affect is detection risk. Okay. So because the only risk we can reduce is detection risk, how do we reduce detection risk? How do we reduce the risk that our own procedures will fail to detect and correct material errors in the financial statements? The answer is we need more evidence, right? So to reduce detection risk and therefore reduce audit risk to below 5%, we need more information, right? More audit evidence. Okay, and my computer just froze up. Okay, so I'm gonna have to go out and I'll be back in a minute, okay? Okay, sorry everybody, my computer froze up there for a few minutes, so I had to go out and come back in. So I'm just going to advance up to where we were in the PowerPoints. Okay, we just finished off talking about audit risk. Okay, so to reduce, again, to reduce audit risk is a part of, has three components: inherent risk, control risk, and detection risk. The external auditor cannot affect inherent risk, cannot control control risk because it's determined by management. The only risk the auditor can control is detection risk. So if the auditor wants to reduce detection risk and thereby reduce audit risk, the only way to reduce detection risk, again, detection risk is the risk that the auditor's own procedures will fail to detect and correct a material error in the financial statements. To reduce that risk, the auditor must do more work, right? Obtain more audit evidence. Okay, so some of the detailed work that goes on during the course of an audit we'll talk about now for a few more minutes. The last few PowerPoints really detail some of the day-to-day work that auditors would do, okay, in the course of an audit. So audit planning, we've mentioned already, but the fact that before an audit is started, it's planned. When are we going to do the audit, right? We're going to go there to the client's premises before the end of the year, after the end of the year, both. Who's going to work on the job, right? What level of people, right, in the audit firm, right? Who's the audit partner going to be? All those types of things. But that planning, yes, is done at the start of the audit, and we set an audit budget, right? How much time are we going to spend on this audit? But the planning may change, right, during the course of the audit. Why? Because we're obtaining audit evidence. And as we obtain audit evidence, we may find we have to change the procedures that we had previously planned. And there's nothing wrong with that, right? It doesn't mean the plan was wrong. It just means that the plan has to be changed because we have new information, right? How often in real life, right, do we change what we're doing because I have new information, right? And of course, when we go through a course and we get evaluated, right, how am I doing? Well, not well. If I'm doing well, what do? I do more of the same things, don't I? Because I'm doing well. On the other hand, if I'm not doing well, what do? I have to change some things, right? Change how I study more, right? I have to change something in order to get a different result. Audits are the same way, right? We start out with a certain plan, but as we gather more information, sometimes we have to change what we're doing. So that's just part of the process. It's part of the ongoing process. When auditors plan, they actually create something called a planning memo. Here they call it a planning memorandum, right? But in short, we just usually call it a planning memo. And it summarizes the preliminary analytical review that we did on management's internal financial statements, right? What's it look like? Is there anything that looks terribly wrong, right? When we look at the initial numbers, it includes our decision on materiality, right? We've discussed before how to determine that, and our risk assessment with respect to different directions about the effect on the audit, right? Our risk assessment, what's going on in the client's business environment, right? That might affect the audit this year, right? Might affect some of the numbers in the financial statements, okay? That type of thing. Right now, if we think about if we're auditing a client for 2020, what would be some of the things that would affect the client's financial statements? Well, you would expect to see them spending a lot of money on preventative equipment, right? Safety equipment. They probably have a lot of expenses for PPE, right? That type of thing. If they're a manufacturer, maybe they changed and are actually manufacturing PPE, right, for the general population. Whereas before they produced cars or whatever it was that they were producing before, they switched their production, right? So the environment, right, in which the business is operating, of course, can change the nature of the business operations and change the numbers, right, that appear in the financial statements. So the planning that's done right at the beginning of the audit, of course, is the basis for what's called the audit program. Okay, what is the audit program? The audit, looking at the PowerPoint, the audit program specifies the procedures. This is the detailed audit procedures that the auditor will use to guide the work of inherent control and control risk assessment, right? Remember, audit risk is what? Inherent risk and control risk. So we have to assess, right, in the inherent control and control risk in the current year and use our assessment, right, on those two items to determine how much we have to do to obtain sufficient, okay, it says competent evidence, should be sufficient appropriate evidence as a basis for our report, right? We use our assessment of inherent control and control risk to determine the other procedures that we have to do to obtain sufficient appropriate audit evidence. Okay? So the auditor, as a consequence of their assessment of inherent risk and control risk, will determine what's my audit approach. Is my audit approach going to be a control approach, where most of my work is internal control testing, combined with a little bit of analytical and substantive tests of detail? Or is my work going to be all substantive? The client's internal control system is so bad, I can't rely on it at all. All my work has to be tests of detail and analytical procedures. Or I can do both, right? So for a large public company, the answer is usually combined. A lot of reliance on internal control testing combined with some work on analytical procedures and tests of detail. Okay, different types of audit programs. I'll just mention this a little bit to give you some overview. Again, we'll be talking about this in more detail after the midterm exam. So the risk assessment, right, has to go on at the start of the job, start of the audit. It says the risk assessment program. This lists of specific procedures for gaining an understanding of the client's business transaction processing systems and controls over those systems, and as well for assessing the inherent risk and the control risk. Right? The auditors, when they start their audit, have to assess the inherent risk in the audit, the control risk in the audit, okay? And depending on their assessment of those risks, excuse me, combined with their understanding of the client's IT systems and accounting processes, that will tell them how those risks are going to impact the other two programs. The internal control program, as we see here, it's a specification of procedures for obtaining and understanding the client's business and control systems. So we have to assess how strong is their internal control system. Why? Because that's going to tell us whether we're going to rely on it or not, right? We have to look at the client's internal control to assess control risk. We can't determine whether the client's internal control system will prevent, detect, and correct material errors until we study it, right? We have to study it to determine whether the system would do that or not. Balance sheet program, a specification of substantive procedures, again, analytical, tests of detail, for gathering direct evidence on the assertions about the dollar amounts and accounts. The internal control program, reviewing and testing the internal controls, most of that work is done before the end of the fiscal year. The balance sheet program, normally most of that work is done after the end of the client's fiscal year. Why? Because you need the actual dollar amounts, right? You need the actual numbers in order to do the tests that we're talking about. All the information the auditors prepare during the course of the audit are called the audit working papers. Legally, they are the work of the auditors, and they are entitled to keep those records. Okay, no one else is entitled to those. That records, of course, whether the work that they've done is in accordance with generally accepted auditing standards. Okay, the auditor is the owner of the working papers. Okay, and here it mentions there are 3 categories of working papers. It says mentioned, usually stored in 2 files. Now again, some of this is really based on years ago, right? The very first firm I started working with was actually what is now called Ernst & Young, okay, Ernst & Young. And this documentation that the author is speaking to, this is essentially the Ernst & Young way of recording audit documentation. All the major firms have their own systems, okay? They're very similar to what you're going to be seeing here, okay? But this is in particular the Ernst & Young system, just so you know what it is that you're looking at here. So 3 categories of working papers, says stored in 2 files. So they just give you some background as to the type of files. All firms will have these files. They just call them different names sometimes. So the permanent file, we already mentioned, is information which does not change from year to year. So for example, articles of incorporation. Another example would be a bond debenture for 25 years, right? A bond where they borrowed for 25 years. That's not going to change for 25 years. Current file, that's going to be all the information that they gather in the current year to support their audit opinion on the current year financial statements. Okay, so that's going to have your audit plan in it, all the other audit evidence and the decisions that you made during the course of the audit. The information in the permanent file, I've already mentioned what it is, the types of things that go in there. The audit administration file, again, just another file. Some firms have a separate file. Some of them just put it into the current year file. Engagement letter we have from the client, right, who's going to work on the job. That's the staff assignments. Organization charts for the client. Meeting notes of notes of meetings you have with the client. What's the overall audit strategy, right, for the audit? Internal control questionnaire. We'll see this after the midterm exam, but all firms have a standardized questionnaire for internal control systems, right? Because every client's internal control system basically is the same at a high enough level. Okay, so auditors have gotten very efficient on how to audit accounting systems, and they do it with standardized internal control questionnaire. What's the audit plan and the audit programs? The programs being the detailed procedures we're going to do. The client's trial balance, right? Any year-end adjusting entries that are made, and then review notes. Okay, review notes of the partner or the audit manager. There's a question about whether the review notes should be kept in the audit file or not when the audit's done. Some firms keep the review notes in the file. Some firms destroy the review notes. Okay, so one reason for keeping the review notes in the file is to prove the file was reviewed in accordance with generally accepted auditing standards. On the other hand, a reason for removing the review notes is to ensure they do not contain information, which of course could hurt the firm if they were subject to a legal challenge around the quality of their work. Right? Maybe there'd be something in the review notes that might run counter to the firm's best interest. So some firms choose to destroy the review notes on the basis that once the audit is done, the firm's position is that the audit has been done in accordance with generally accepted auditing standards, and the review notes do not add to that. Right? It was one way that we ensured the audit was done in accordance with generally accepted auditing standards. So again, firms have different approaches on whether they want to put that information into their file or not. Then this PowerPoint just talks about how the file itself is organized. So typically files are organized, and again, you don't have to know this for exam purposes, but just so you have an idea. Normally they're analyzed alphabetically. So for example, bank or cash is the letter A. Accounts receivable in most firms would be the letter C. Inventory is the letter D. Okay, so different alphabetical letters will have different components of the balance sheet and income statement attached to them. Again, each firm is different. There's no one set way that's common. Alphabetical is most common, but firms have different approaches. Excuse me. Again, we're going to talk more about the assertions after the midterm exam, but the audit evidence, okay, our working papers must show what were management's assertions and how were they audited, right? What information did we gather to support our audit opinion that meant the management's assertions were true? The working papers have to disclose, was the work properly planned and supervised, right? Think back to when we were talking about generally accepted auditing standards when we first started the course. We said one of the standards is the work is properly planned and supervised. Is it? Of course, it has to include the audit evidence that's been gathered. Not only was the information gathered, but how did we evaluate it? Right? What was our evaluation? We have to document our evaluation of the audit evidence gathered. And then when we found misstatements, when we found errors, how did we handle those? Did we make the client remove the effect or correct, right, the misstatements? Or did we as auditors just live with that? Right? And then copies of any letters, of course, that went to the client during the course of the audit. We need to have those in our audit file for future reference. Again, should there be for our own reference, for carry forward purposes for next year's audit, but also in terms of legal challenge, we want to be able to prove, right, that we had proper communication with our client. Again, this PowerPoint is just talking about the ordering of the working papers, not important for our perspective, as is this one. This particular PowerPoint, the very last one, talks about audit working paper software. So all the big firms, of course, are using computer technology to the maximum advantage, because the more you use computer technology, the more efficient you can be on your audit. And I think back to, when I started auditing, it was just before the introduction of desktop computing. And we used to do consolidations, right? Preparing consolidated financial statements. And so you would have a parent company with, let's say, 50 subsidiaries. Well, in order to prepare the consolidation, we've had huge sheets of paper with 50 columns, right? And you put the balance sheet and income statement information for each company in one of the columns. And then when you would have to add and cross add, right, this huge sheet of paper. Well, this could take days, right, in order to get everything balanced, right? Well, of course, now you can use Excel, right? It's going to be very quick to find out where the errors are, right? So Excel was a way to increase a lot of efficiency into the audit. And of course, Word and Excel, and then but specialized software as well that the major firms have developed, right? And again, there are commercial softwares available out there for smaller firms that don't have the internal capability of developing their own software. But everybody has some type of software that they're using in the audit function, right? So of course, the main purpose of that is to increase productivity, right? Of course, because of technology, we can download client databases, right, into our own computers as auditors, and then work on the client's data, right? So again, it makes it very flexible in terms of extracting information to use in our audit tools that we have. Okay, and of course, facilitates analysis because we can get access to information faster, right? Hook up to other websites to get information, etc. So we all know the advantages, of course, of computer technology in terms of efficiency. Those same efficiencies have been worked into the audit process. Okay. All right, so that finishes off today's lecture. I went over, I think, a little bit on time, so apologize for that. But we're pretty well set here. We're just right on target as far as the course outline goes. Again, please remember you do have the group project to get in by Friday. And next day, I will speak to the midterm exam to give you a little more guidance as to what the format of the exam will be, okay, and what you can expect there. So have a good day, everyone, and we'll see you on Wednesday. Okay, take care.